Hi everyone, Ricardo Gonçalves here with SBS On The Money from the SBS Newsroom. It is your daily 10-minute business and finance news wrap, and it's Monday, the 28th of September 2020. Later, despite the recession, one Sydney property was sold for the highest price on record at an auction at the weekend. So, where to for the sector despite the current environment? We'll have more on that later in On The Money. But first, to the Australian share market today, which fell 0.21% on the S&P ASX 200 to close at 5952. The index actually didn't move much all day. The banks declined, but tech stocks did well, so too travel shares. For more, I spoke earlier with Elio D'Amato, the Managing Director at Spotty. Elio, a pretty uneventful day for the share market because it was pretty unchanged for much of the day. What are investors waiting for?
Well, it feels like we're all taking a deep breath before that first presidential debate that's going to occur Wednesday our time. The market's a bit unsure as to how that's going to play out, and I think once the market gains a little bit of certainty there, that may very well help short-term sentiment. Over the broader sense, the market's still a little bit nervous about how hard the tech stocks have run in the US. Obviously, they've been pulling back a little bit, and investors may be very well hoping for some sort of basing pattern to give them confidence that the worst of the recent sell-off may in fact be over. But of course, COVID-19 continues to be the actor that never goes away, and I'm sure the plot line will be very much linked to developments there, not only here in Australia, but obviously overseas, particularly in Europe.
One sector which did do well today, travel. Can you run us through why?
Well, obviously, it's a sector that's been battered over the last 12 months, and unfortunately, doesn't look like its prospects are going to improve in the short term. However, investors are very much betting on the idea that the worst may be over for a lot of participants in the space, particularly companies that have already raised a lot of capital in order to survive the downturn. And now, as our restrictions start to ease somewhat, particularly outside of Victoria, there's some starting to feel a little bit more confident that the worst may in fact be over. Further to that, corporate travel, which is a company that services the business sector, they actually have gone into a trading halt. It is likely that they're going to be making a rather sizable announcement about a game-changing acquisition, and that's to be expected. In a time when sectors get belted, inevitably those that are strongest will survive. They come out the other side and inevitably acquire companies that haven't done so well. And the company sees this as transformative, so it'll be interesting to see what they do. And that general positive sentiment very much washed over the other companies that it looks like they're back open for business.
One of the other corporate stories of the day is A2 Milk, a profit warning from it, essentially because it can't sell its products to the Chinese. So what do you know of it?
Well, today we learnt, unfortunately, the impact of the closure of the Daygale channel, which is where Chinese tourists come to Australia and they buy the goods and then take them back home themselves, which has traditionally been a very large part of the A2 Milk story, as well as other companies that have benefited from it. And with travel restrictions, of course, the companies had no choice but to downgrade its earnings. It's important to note, though, that it's still growth on revenue expected from the previous year. It's just that it's less than expectations, although, again, not by all that much. The market, of course, is concerned by two key factors. One, yes, the disruption to the Daygale channel. When will our borders open up to Chinese tourists once again? But then the other element, of course, is the ongoing concerns around the Australia-China relationship, particularly with Prime Minister Morrison coming out and saying again, reiterating his view that there needs to be an investigation into the origins of the coronavirus and what that could potentially mean, because A2 Milk has said that they expect their future earnings growth trajectory to come from selling products direct through the Chinese market with Chinese labels and the like. Now, we've seen them take the bet on barley, we've seen them take the bet on wine, and possibly some investors may now be thinking that infant formula could be next. It's a pretty long bow to draw, but I can understand why investors would be nervous.
Elio D'Amato there, the Managing Director at Spotty. We also heard today from the Chief Economist at Westpac, Bill Evans. He has adjusted his interest rate call. Last week, following comments from Guy Debelle, the RBA Deputy Governor, Westpac said the RBA would be cutting official interest rates on October 6th. That is budget day. But today, Bill Evans said that the RBA would now likely wait until Melbourne Cup Day, so that's the next meeting in November, as to not steal the government's thunder when it's trying to sell the outcomes of the budget. But not everyone agrees that we'll even see a rate cut. Here is Ryan Felsman, economist at CommSec.
Well, the Commonwealth Bank's group's forecast so far for interest rates is for no change. We think that the Reserve Bank is most likely to increase its bond buying program in preference to cutting interest rates. We think that with market rates currently at around 0.08%, certainly the cause for concern would be that if the official cash rate was cut to 0.1%, that could push some of those market rates into potential negative territory. Also, the implementation operationally for banks and others would be quite challenged on the back of those cuts. So certainly our case at the moment is for no change.
Ryan Felsman there from CommSec. And while we're talking interest rates, it'd be appropriate to talk about property. Now, a 5-bedroom home in Sydney's eastern suburb of Vaucluse has become the most expensive house ever sold at auction. Last sold at 2013 for $11.3 million. It is unrenovated but has sweeping views of the harbour. It's been sold to a young Australian-Chinese couple who plan to live in it for $24.6 million at auction. That is a staggering $10 million more than reserve. So, given the recession, what's happening with the property sector? I spoke earlier with Louis Christopher, the Managing Director and Founder at SQM Research. Louis, we saw a record in Vaucluse at the weekend. What's that saying about selling activity in Sydney, and is it really reflective of the overall market?
Yes, indeed. It was a record under auction conditions in Vaucluse. It was a huge sale. It is telling us that the market potentially is picking up, and we are seeing that through a broader rise in the auction clearance rate. We believe that the final auction clearance rate from last weekend will probably come in at the mid-50s level. And that does actually suggest to us, if we're right, that the market is actually starting to rise. In recent months, we've been getting auction clearance rates in Sydney's in the 30s and 40s. But in recent weeks, it's actually crossed over that all-important 50% barrier. And some bodies are reporting clearance rates in the 60s and 70s. We don't think it's that strong, but it's definitely now over 50%. And historically, that has meant prices are rising under such conditions.
We're also seeing some reports of some pent-up demand in Melbourne, given that it is in lockdown. Do you think that's true?
At this stage, it's really difficult to read the Melbourne market because there's hardly any transactions going on at all. It's effectively a frozen market due to the lockdowns. Now, I note the recent lifting of restrictions, which includes the ability now to actually inspect private properties. So we are anticipating that there will be a pickup in auction listings and overall listings for Melbourne over the next few weeks. Once we see that, we should get a better understanding what is going on in Melbourne. Of course, we've got a situation where there would be many sellers and many buyers looking to move property, and they have not been able to do that. So potentially there is some pent-up demand by buyers just simply looking to upgrade, downgrade, and change over.
So in a national context, how would you describe the overall market, and where's this correction everyone was really expecting?
Overall, it is a mixed market. We're seeing real strength in regional Australia. There's been a major shift in the population from inner city living to outer regional locations. So there's been some strong sales activity out in regional Australia, that's for sure. In the inner city areas, we're seeing price weakness. So when we consider the CBDs of Melbourne and Sydney, where we do have transactional evidence, it's definitely suggesting that units in the CBD have fallen hard. Overall, we haven't had the crash. It's been averted. And the reason behind that is all the stimulus activity that we've actually had from the federal government, that being in the form, of course, JobKeeper, getting many businesses and jobs alive, as well as the aggressive cuts in interest rates that we've already had.
What do you think will happen once they're wound back?
It's a very good question. It really does depend on how quickly they're wound back and how importantly that the banks are going to manage all the home loan arrears that we have right now. There's many thousands of borrowers out there who have still not been able to meet their mortgage repayments. If the banks go too hard on them, we could see a lot of forced sales activity. However, if the banks manage that okay, then there's potentially the chance here that we will not have that dark storm come along and create a housing crash.
Just finally, there's talk of official interest rates falling from 0.25% to 0.1%. Will that actually make a difference when we talk about the housing market?
I think it's unlikely the banks will pass all of that on. I think they're going to keep much of that rate cut for balance sheet restoration. The bank's margins are no doubt getting squeezed right now. They'll be wanting to keep much of that. There might only be, say, 7 to 10 basis points being passed on to home borrowers. And so I don't think it'll make a lot of difference. But let's just keep in mind that overall, if you're a borrower on good credit right now, you can get a lending rate of about 2.5%, which is very, very low. It's a record low. And that in itself has helped prop up the market.
Louis Christopher there from SQM Research, and we will get the latest property price data from CoreLogic for the month of September on Thursday. That is On the Money for this Monday, the 28th of September 2020. I'm Ricardo Gonsalves. You can follow me on Twitter @business.